Mike, the banks are getting hammered today. It's the regionals, it's the majors. What is the lasting fallout of today's price action on the banks?
Well, in the near term, it's earnings hell for the banks. It's the trifecta of misery. I mean, you have, you have the virus, you have oil, you have interest rates, and we've taken our numbers down by 1/5 over the past couple weeks. And today we said that the bear case scenario could be an earnings hit, not just 30%, we had increased that to 35% earnings hit to banks. So I think if you're looking at the short term, it's rough days for the banks, and most of that would be simply what's known as the net interest margin, the difference between what banks borrow at and what they lend, and that's painful, and there's no escaping that, there's no sugarcoating that. Banks have to come out and say, look, the expectations, the guidance we gave you before is wrong. Think of this as a sick leave for bank profits.
We don't know how long this is going to last, though. This selling is panic-induced, it's coronavirus-induced. There's a couple of black swan events out there, this oil war and so on. How convinced are you that we're going to start to see defaults at banks and that some of these loans are going to go bad, for example, and that interest rates really are going to stay low, maybe even go down as far as zero, maybe even into negative territory impacting banks? How can you be so sure?
Well, look, our earnings cut of almost 1/5 so far and up to 35% does incorporate some higher credit losses. But compared this to the financial crisis, it's night and day. So while it might be earnings hell, to some degree, it's balance sheet heaven. Bank balance sheets are the strongest that they've been in a generation. Banks have $1 trillion of additional capital, $2 trillion of additional cash, $3 trillion of additional deposits relative to before the financial crisis. So banks can absorb a body blow. And by the way, you have something known as the Fed stress test. For almost a century, the Fed had no stress test. For most of the last decade, banks have to incorporate a theoretical Armageddon scenario, and only if they can, survive something like that, then they can return capital. So the resiliency of the banks, is very strong. The foundation of the banking industry is strong. One question that we've gotten is, are banks going to, quote, implode? No, that's not going to happen. They're very strong. Having said that, earnings are at risk. They're going lower. They can go lower still, and that impacts stock prices in the short term, and we can't escape that.